Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.
Hello, my name is Michael Stoller. At one time in my life, I was an accountant. And, in that prestigious industry, there are guys who run major businesses in New York, the accounting and consulting business. And today I brought in some top members of the accounting profession to provide their thoughts on the state of the market and the economy. My guest today is Frank Schettino, managing partner in charge of Anshin Block & Anshin. Bruce Madnick, managing partner of Friedman LLP. And last but not least, he's not the managing partner, but he's the chief operating officer. So as Bruce would say, he's even higher. Okay, Dom Esposito of J.H. Cohn. So since you're the COO, you knew it. You wanted me to say the bit over there. So since you're the COO, how do you see the economy affect on your business and the business of accounting and consulting today?
Well, for the mainstream of our business, Mike, which is owner-operated companies, those companies are, at best, very cautious about their future. They're having tough times on margins, tough times on revenues, a tough time with working capital, and it just trickles on down to bad morale with the employees because of layoffs. That affects our practice because our practice, while it does lots of work for the owner-operator, also does considerable amount of work for transactions around their business, and the transactions have dried up.
Bruce, what are you seeing? I mean, you have a diverse practice, the same way that J.H. Cohn, the same way as Anshin. What are you seeing? Because you prior to the show, you were talking about everybody after tax season, as they say, April 15th, but I still remember tax season to be October 15th, the time I filed
still
by.
Is.
Okay. You had staff reductions, and each year. So how has it been this year compared to last year?
Yeah, well, I think what you have to remember is that we all came off an unbelievably successful 2008, and all of us thought that this was going to continue forever, and we staffed up really looking for even a bigger 2009. As the October crash came about and we went into the 2009 season, we all knew that we were going to be busy through the end of April doing publicly held companies, doing year-end work and tax work for privately held companies and for individuals. But the reality is, as you project out for the balance of the year, there's going to be a drop-off in business. As Dom said, there is very little, if any, transactional work, and therefore we all looked at staff and really curtailed our hiring policies and laid off people that were marginal at best, where in the past we would have carried them towards the end of the year.
Yeah, in the 80s, every time there's a recession, there are industries that are created. In the 80s, the Microsoft came out, and then in the 90s or the end of the 90s, you had some .com companies that came into the business. Some were out of the business, but that was the time of Yahoo. That was the time of AOL over there. what do you see, we were talking prior to the show, what do you see in this recession as the new opportunities, the new type of companies that are going to be coming out that your firm would be servicing?
I see a lot of entrepreneurship that's going to happen over the next 3 to 5 years. Our firm specializes, one of our niches is financial services. We audit over 400 hedge funds and investment partnerships. We're seeing a lot of that, and we specialize in the startup hedge funds. Many firms don't have that particular niche. And we're seeing opportunities today with the downturn of Bear Stearns and Lehman Brothers and some of the financials, where many of the middle management people that work for these companies are going out and trying to start small hedge funds and then looking to us for some guidance. So from our perspective, we think short term, we have had some short term downfall, but in the long run, we think we're going to be much stronger at the end of this recession.
And Bruce, you were mentioning prior to the show that one area that you've seen an increase is like nonprofits.
Sure. Not only in the nonprofit, which we think has been a neglected industry. People usually take that work on to fill in for underutilization of staff. So we've done a huge telemarketing campaign, and we have found 70, 80 different nonprofits who are so happy to see us because somebody ultimately cares. We've also seen some huge growth in the taxation area. The states and the federal government are clamoring to raise taxes, and the states are very aggressive in the audit area. So we've bulked up our state and local taxation area, where we're helping people with nexus issues, with making sure that they're making full disclosure. Also in the international tax arena, the government has been extremely aggressive in chasing after money overseas that has not been reported by U.S. Taxpayers. So we've established a much stronger international presence to help taxpayers and companies deal with the ever-pressing international tax issues.
Now, Frank, you were saying that one area that you're seeing is a lot of people have been calling you because of the 9% tax on most people, and also in New Jersey there's a similar situation, to stop becoming snowbirds to Florida, but a different type of snowbird because they want to reduce their taxes.
Yeah, we have a high net worth practice. Many affluent people that live in New York State, New York City. And very quietly, Governor Patterson has put through a effective 30 to 35% increase in New York State income taxes effective January 1st of 2009. Many of our clients who have had homes in state tax havens, whether it's Florida or Nevada, are calling us to solidify their residency status and to follow up with their plans much more aggressively than they have in the past.
You know, Bruce brings out a very interesting thing which relates to, I think, all three of you. You said you went after the nonprofit organizations by a telemarketing approach to call these people. Now, I can't miss a New York Times, a Wall Street Journal without seeing a picture of Joe Torre advertising for J.H. Cohn. Right. And, you know, if you listen to Bloomberg, you hear an Anshin Block an Anshin or an Anshin commercial. I remember when we were younger accountants, as one would say, advertising was like healthcare advertising. It was a criminal activity that you would advertise. How is that advertising done with Joe Torre, who's no longer with the Yankees, having an effect on your marketing?
Well, I'll answer that question. But first, we didn't hire Joe Torre because he was a Yankee. We hired him because he stands for what an accounting firm stands for: integrity, good leadership, coaching, and so forth and so on. As it turns out, we have an office in Los Angeles, so even though he's now in L.A., not helping us as much in New York, he still stands for those things, and Joe's a very popular guy. To answer your question specifically, it has been tremendous for us. Not inexpensive, but tremendous. He's opened a large number of doors for us. The reason why we did that, Mike, initially was our firm is principally a New Jersey firm. We wanted to raise our awareness in New York. We did a number of things around that, including having Joe as our spokesperson, and he's opened up lots of doors for us. So we are a strong supporter of that branding.
And what about you? I mean, with regard to going to Bloomberg Radio?
You know, you never can tell what direct advertising is going to do to your business. But I will tell you, the two largest clients we've gotten in 2009 have told us they either saw us in a Cranes article or a Crane's advertisement, or they heard the name Anshin on the radio. So indirectly, I think the advertising is helping tremendously.
Bruce, any idea?
Branding is critical. I mean, we work to be the #1 provider in different segments, one of them being real estate, one of them being technology, one of them being apparel textile. We just want to be one of the top 2 or 3 go-to people, and name recognition is critical.
And you know, we were also bringing out, you know, going back, it was Friedman, Alpert, and Green.
Right.
I mean, you're still called Anshin, Block, and Anshin. J.H. Cohn.
Although we have gone to Anshin in the tagline.
But I mean, that's the interesting thing. You know, the one name is going there to the situation because of it's like the branding in the situation.
It is branding.
It's branding. Absolutely branding.
It's a total branding.
Sure.
You know, so what cottage industries are going to do well in your mind? I mean, you're talking about entrepreneurs. You know, where do you see this recession? It's a two-pronged question. You brought up the fact that some of your entrepreneurs are having difficulty. How are the banks? And I'd like to, because I know all 3 of you deal with the banks today. Are you seeing them putting more? Are they harder to get loans for some of your clients?
I would say in many cases it's impossible to get loans for a good number of our clients. The banks have made it very difficult. They're not in the business right now of lending, and at least that's been my experience. And therefore these clients are trying to get more out of their capacity with less capital coming in from the banks. Very, very difficult.
Bruce?
Yeah, we're finding also that the banks are keeping their good clients and keeping them happy. We've seen several of the banks raise their floors on interest rates so that they're not necessarily prime related, but there's a floor. The big deals seem to still be getting done, but the smaller deals are much more difficult. They're not cash flow deals anymore. They're strictly balance sheet related deals. Guarantees don't mean that much anymore. It's just a much, much tougher market. They all say they're in business and doing business, but it's far and few between.
Right. You mentioned something about guarantees, and I had a younger partner come to me last week, and I won't mention the bank, and he said, I have this real estate client looking to refinance, and do you believe the bank has the audacity to ask for a personal guarantee from this loan? I mean, but that's the way it used to be.
No, it's interesting. I did a couple of shows over the years, and I have one person by the name of Norman Sterner of Murray Hill Properties is on the show, and I said, Norman, what about that term recourse or guarantee? Yeah. He said, I forgot that word. Right. I said, but unfortunately that word has come back to...
There's a whole generation doesn't know that word.
But you know, here's the question. You're talking about new startup hedge funds. You're talking about new companies over there. All of you with entrepreneurships. If the banks aren't lending, how do these people go into business? You know, how do they fund their operations?
They're funding it. At least in our experience, many of them have gone through their own stress test. Where can we get more liquidity out of the business? Where can we generate more margins? Where can we downsize our workforce? What new markets can we enter into in this day and age where maybe our competition is suffering more than we are? Maybe we could exploit and mine that vein. So they're trying to do more with what they have. But it's not been easy. I mean, the revenue growth for these companies has been very, very tough.
Yeah. And there's a lot more consolidation. The strong are taking over the weak. The opportunities are available, and they need to take advantage of them.
So here's the question. You know, the government puts all this money. They say you have this TARP money, you have this TALP money, you have this PIP money, you have all these new acronyms, and you're supposed to lend.
I think it's made the lenders more conservative, if anything, or more gun-shy to pull the trigger on marginal deals.
So who's lending in this market? Is the J.P. Morgan's, Chase over there, the Bank of America? Do you see them? I'm not talking about real estate lending. I'm really talking about all type of lending. Do you see the big names? You know, the Capital Ones, the others, my good friends at Capital One, are they in the market to lend?
You know, I think Bruce hit it on the head before. The right type of deal, they're lending.
For their best customers.
Yeah,
exactly. For their best customers.
But they're raising rates pretty much across the board, even for the best customers.
Exactly.
We've seen 200, 250 basis points.
But Frank, I think part of the situation is when LIBOR is so low, banks can't operate at that low level.
Exactly.
You know, as I tell some people, you know, you have to look at really the cost of funds. It's the same way that you're running a practice. You have overhead for the office. They have the operations. They can't afford to lend at 2%. So you have to look at it this way, in that manner. Now, how, I mean, all of you know, you said before the show, the firm's revenues have grown 300% over the last.
We've tripled in 10 years.
And yours have.
We're growing 15% a year.
When I joined J.H. Cohn, we were doing about $80 million, and here we are 7 years later, we're doing $250.
So, what do you project with this recession, with the economy? How is 2009 and 2010 going to be for your firms? And how are you going to, besides the way that you were talking about, you know, going after some cottage industries, how do you think you're going to try to do different types of things in this recession?
Yeah.
And because there's no end in sight, I hate to say.
Well, we believe for 2009 we're going to be flat, and that'll be a win. And what you need to do is then control your costs, which ultimately results in termination of people, because people are our inventory. And you watch every other expense very carefully. But I think the important thing is not to curtail all of your spending so that you go into a shell, because all of us continue to need to be bigger, stronger, to have a bigger capital base, to invest more in technology and in talented people. And if you don't spend money, you can't get there.
Talent is the key in public accounting. Without talent, you're nowhere. And even in a downturn, you want to be able to retain your best people, because this will turn, and what you don't want to get is caught in the trap where you're now having to hire 25 or 30 or 50 people and having placement fees and really skewing the overhead structure again. So it's really a fine line between cutting the right amount of people without really affecting morale and effectiveness of the office. You know, I read a book once that said every year a CEO should cut 10% of their staff. Good year, bad year, doesn't matter. There's always 10% of the staff that are non-performers. I don't think any of us abided by that rule over the last 5 years. I think we're starting to do that now.
Right.
Yeah, and Mike, for us, again, the transactions with our clients have dried up, but they'll come back. But in the meantime, what we're doing is we're trying to mine new avenues for growth. There's lots of regulation coming out of the administration. We're doing more regulation consulting. The private equity funds aren't doing any deals, but they're trying to make their portfolio companies more profitable. We're exploiting that vein. So it's those types of things. But at the end of the day, our firm is principally an accounting and auditing firm and a tax firm. And if the clients aren't doing transactions, it's going to hurt our revenue. So our revenues are going to be down also.
Yeah, but you know, an interesting situation. I moderated a major symposium last week, and I had a panel on the office market, and the comment that many of the major world-renowned office leasing and owners said, we are doing something called an extend and blend, which might be, and what I mean by that is, you know, you have leases, and all of you have large leases, you know, in your buildings. The landlords today, you're good credits. Sure. I mean, because at one time, you know, everybody thought AIG was a good credit, you know, Citibank was a good credit, but you are a good credit. You've been in business 70 years. I mean, all these years.
It has to be, because I get calls from real estate brokers every day wanting to show me space. So.
No, but what I'm saying to you in a simple manner is, you know, as opposed to cutting the expense by cutting labor and the bodies, a good possibility, and I'll give you a true story. Steve Siegel tells a story of a law firm who had a rent coming up, and the rent was going to be $110 in 2 years. And what happened is they then were going to locate. We were going to forget the lease, and they were going to move down to Lower Manhattan, and they were going to pay $60 a square foot. The landlord said, I'll extend the lease, give you another couple of years, and I'll reduce your rent to $60. So what I'm saying is, in the same manner of looking to reduce overhead, perhaps, you know, that is another venue of reducing overhead.
Maybe for these gentlemen, not for us. We have a great lease and a very good relationship with our landlord. And I think we're different than law firms in the fact that we're still doing very, very well. You know, we're coming off double-digit increase years for the last 4 or 5 years. You don't have to tell
your landlord that.
But you know what? I think it's an honesty situation, and to be quite honest, we're doing quite well. And I wouldn't go to my landlord for a rate reduction. I don't see it.
Yeah, I agree. And I also see tremendous opportunities to acquire firms and people and talent. and provide new market niches due to those acquisitions.
I think, but all of you have made acquisitions over the last couple of years, which has helped your firms grow, increasing the size and the situation. What about the suburban offices? I mean, J.H. Cohn, going back when I remember J.H. Cohn, their roots were Newark. I mean,
That's
this was, I think you are still the only major firm who's based, with the exception of the Big Four, in Newark. What about the suburb offices, the Long Island office, the New Jersey office? How's their business today? What do you see happening?
Our New Jersey office, which we merged in 5 years ago, has grown quadruple. We started at $5 million, we're at $20 million. A lot of that is because of the franchise. Long Island office, which started at $3 million, is over $7 million. So having the firm behind you, I talk to Dom about this all the time, because they're the king of acquisitions. They have more offices than Carter has little liver pills. However, adding the bulk, the talent, the expertise, and the resources gives you a great growth opportunity.
You know, it's interesting, Anshin, Block & Anshin is the largest single office accounting firm in the country. And although we've done acquisitions, we've done 4 at this point over the last decade, we haven't done a regional merger. And we've looked at many situations, and at the end of the day, how are we going to get our processes in place? How are we going to get our procedures in place?
So you operate just out of the Manhattan office?
One office, 115,000 square feet on Broadway.
But now you've been like the Jolly Green Giant, you know, the 800-pound gorilla.
You've done a great job at it.
I mean, you've done a great job. I mean, from Newark, you know, how many offices?
We have 10.
10 offices.
We have 10.
But you've changed your franchise from a city of Newark, which many people, it's a tough place to do business in, you know, certain markets, to you've grown into New York. I mean, you were not a New York-based firm.
No, we're not in New York. We've been in New York many, many years, but on a very small level. And we see Manhattan as our greatest opportunity as a firm. So even though we've grown into 10 geographies, our greatest opportunity as a firm is in Manhattan. We still believe that today. Although we want to go into other geographies beyond the 10 that we're in. We have plans to go into Boston, Philadelphia, D.C. We're also on the West Coast, L.A.
Via merger, or would you open up an office called Turkey?
The way we do it, we start off with a merger. That gives us a foundation, and then what we do is we bring our brand into that merger and help it grow.
You know, when we were all younger, except for Frank, he's younger than all of us. When we were all younger, there was something called the Big 8, and then it went to the Big 6, and then it went down to 4. I mean, it shrunk to 4. Those 4 firms still handle most of the Fortune 500. I don't think there's Fortune 500 companies anymore, and you know, they handle that thing. Where do you see, being prominent middle market accounting firms, do you see great opportunities to take from these people, or are they becoming threats because in the years that you did so well, you know, they did even better? Do you see, what effect do you see the PricewaterhouseCoopers and the Ernst & Young, where do you see them? Are they going after your business today, or what's happening? Well, or is it a great opportunity for you?
We subscribe to the philosophy of you go where the giants aren't going. And the giants are very good at the Fortune 500, and they're terrific firms. But it's different servicing an owner-operated company. They're looking for a different skill set, a different mix of talent. And those firms, while they're very good at doing one thing, you can't be everything for all different markets. So the middle market is vast. There's tremendous opportunity. And while the Big 4 firms and the larger competitors compete in those markets, we believe we could do a better job. We bring more value, much more reasonable pricing, and a better understanding of the personal and the corporate, and blending all the goals together. So there's a tremendous market out there.
Bruce?
I agree with Tom. The SEC arena and the Big 4 arena is very fertile. For many years, they avoided the middle market because they were chasing the Sarbanes-Oxley work. Now that has dried up considerably, so they're now coming back into our marketplace. But as Dom said, they cannot compete with us from a service point of view and from a pricing point of view. So we see great opportunity there.
You know, we're one of the rare firms that have had the growth in New York without any public company exposure. We have none. We handle no commercial public public companies. With that said, when the Big Four made a downturn because of Sarbanes-Oxley and we had opportunities, even though we didn't have public exposure, it was great for us. Because at $250,000 audit engagement for a privately held company, they felt was too small for them. That was our bread and butter as it is.
Right.
Well,
So
one quick question, because we don't have much time. I remember maybe 8 years, 9 years ago, a lot of the accounting firms went into every other business. You know, they went into the insurance brokerage business, they went into the money management business, and I still remember one firm who's not here today, Weiser, who really pushed their companies into money management. And, you know, what happened to the firms who pushed it? And last year the market went down by 50% and they were the money manager.
Well, the interesting thing is that I think years ago we all dabbled in it because it seemed like easy money, it was low-hanging fruit. And then as our accounting practices became more successful, we didn't pay as much attention to it. And luckily for us, it sort of like dried up and we didn't get stuck with the big problems in the money management area.
Yeah.
Yeah, because that was, you know, everybody wanted the money management. And then, you know, one last, I've been told that I don't even have the last question, which was really about the publicly held, the accounting firms that went to publicly held, which I noticed Mahoney Cohen is now owned over there.
Right.
Next time, Mike.
Next time. But there'll be a next time on the ninth season. I would really like to thank Frank Schettino from Anshin, Bruce Madnick from Friedman, and last but not least, Dom Esposito from J.H. Cohen. See you next week.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman & Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal & Rosenthal, Signature Bank, Sterling & Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.